Hey, good afternoon, everyone. Marty Mazzora here. It is Friday, the 26th of May, 2023, with your weekly economic update. We're going to do the usual, talk a little bit about our index score this week, take you through a handful of the inputs. Then I want to jump to some supportive market/macro statistics. So therefore, I'm gonna do the first part quickly, and then I want to really focus on the latter part. I think that's meaningful stuff. So in front of you is the simple graph of our index, and we're actually doing better, right? The conditions improved 7 points to a negative 24. Negative 24, however, still means that we are amid a setup that suggests recession odds going forward are greater than continued expansion odds. In terms of the inputs that I chose for today, we've got the PCE data that came out this morning. Consumption expenditures themselves went up a bunch, 0.8% on a month-over-month basis from essentially zero. So that was a positive in terms of what it says about the state of the economy. Personal income was also up, call it 0.4%. Annualized up slightly from 5.2 to 5.4%. Mortgage purchase applications continue to trend lower, and that's kind of in the face of some optimism that I'm getting from folks in that space. I listened to a commentator this morning essentially present that, residential real estate is really strong right here. I've got some data here at the end that'll maybe pour a little bit of cold water on that in terms of when you get under the surface a little bit. Consumer confidence, I just showed you that consumption is rising and incomes are rising. However, confidence continues to roll over, at least the last readings of the Conference Board Sentiment Survey and the University of Michigan's folks are not feeling great about their go-forward prospects, and they're actually not feeling great about inflation. They don't think that it's going to come off the boil as much as Wall Street seems to think as has been priced in, although less so lately in the futures market second half of the year. And I've shown you some earnings reports here recently that suggest that on the retail space, folks are pulling back on discretionary spending, at least on discretionary goods. They sure seem to be out there, having a good time, booking cruises and plane flights and reservations for restaurants, etc. Durable goods orders came out this morning, came down a little bit in terms of growth rate, both monthly and on an annualized basis. Ex-transportation, core durable goods, so to speak, actually contracted. So those spending on durable goods outside of the transportation space actually went down both annually and on a month-on-month basis. Truck tonnage, mentioned this on the written blog the other day, that's been rolling over here of late. That's not a good sign for the state of the economy, and it does, of course, comport with what we're seeing in the goods space. PCE inflation, this is the Fed's favored metric, supposedly, although CPI can sure move markets as well, actually is going in the wrong direction here on an annualized basis and on a month-on-month basis. Here today, the S&P was up 1.3% on a day when the inflation data just a few weeks or a few months ago certainly would have sent it reeling lower. But that speaks to what we've been talking about, right? You don't want to short this market. I don't think you want to be a short-term bear in the face of what is, of course, going to end up being an agreement on the debt ceiling. And I'll talk a little bit about that here at the end as well. Commodities continue to roll over. That is a dire indicator relative to the state of the economy. This is the Bloomberg Commodities Index. This is the CRB Raw Industrials Index, is now finding its way to a lower low. And good old copper. We are raging bulls on copper long term, although early March we pulled back on some of that exposure. We're glad we did. You can see it's now penetrating below what would be $8,000 a ton support. So again, this is not a good sign relative to the current state of economic conditions. And then lastly, for the inputs today, the discretionary to staples, or actually the staples to discretionary ratio. Now that flies in the face, particularly of what I just showed you around commodities, right? Commodities going down would suggest the economy is really beginning to see some stress and there's potential downside to come. And here the ratio between staples and discretionary stocks has rolled back over. Okay, now, of course, staples are the things people need to purchase to keep living. Discretionary things are things that they spend money on because they're feeling flush and they have extra money. They're going to buy food and healthcare when we're in a deep recession, but they're not going to buy cars and computers. And here discretionary stocks are significantly, again, after quite the stretch from late January as recessionary fears were growing, where staples were outperforming discretionary after a big move for discretionary stocks at the beginning of the year. Keep in mind, when this goes down, staple stocks are underperforming discretionary stocks. So this is a good ratio to look at about the market implied state of the economy, and you would think the economy is in great shape based on this metric right here. A lot of mixed signals out there, to put it mildly. Okay, so now I'm going to pull over and scroll through this page where I just cut and paste what I think is just really important and compelling information. Like I said, you don't want to be short the market amid a pending debt deal. And this is this morning's headline. Biden and McCarthy appear near a 2-year deal on U.S. debt ceiling as default looms. And folks, that's pretty much all you need to know about today's rally. And here were short-term T-bill yields going to the moon based on risk therein. And here they are rolling over this morning. So the market clearly is believing this headline. Question is, what happens after this dust settles? So a conversation we've been having a lot internally, and a few client reviews, we've been mentioning this as well. Again, I definitely mentioned it this morning. I believe it was my quote of the day blog post. So this is from Bloomberg earlier this week. Some previously steadfast bears are beginning to give up after a 7-month advance has put the S&P 500 at a key level. Hedge funds that make both bullish and bearish equity wagers have snapped up U.S. shares for 2 straight weeks, with total purchases reaching the fastest pace since October, says Goldman Sachs, a binge that's followed persistent selling in the previous 5 weeks. Morgan Stanley clients last week boosted their net leverage, a measure of risk appetite, to the highest level in 2023. Resolve among the bears is weakening after a $3 trillion equity rally that defied everything from banking turmoil to falling profits to U.S. default. A growing fear of missing out on gains may be leading to a reconsideration of their defensive positioning. Risk managers at big institutional firms are saying, look, the markets are going up and you can't sit around and do nothing. You have to participate, says Quincy Crosby with LPL. The cost of missing out may be just too high. Optimism over the Fed, yada, yada. Remember what I mentioned in this morning's written blog. These suffering bears that are beholden to an equity benchmark may be beginning to capitulate. And as it says here in this next clip, that becomes potentially problematic in terms of downside risk for the market. Okay, so investors came into 2023 largely anticipating stocks to hit fresh lows amid a deteriorating economy and corporate profits. Of course, clients, that sounds familiar. As consumers and earnings held up better than feared, that has led to a wave of unwinding of bearish positions. Now, with broad exposure becoming more balanced, that likely makes the market vulnerable to negative shocks. With systemic equity leverage sitting at a 1-year high, a 2% down day would wipe out demand from that cohort, and a daily drop of 3% could spark selling to the tune of 15 to 20 billion in the subsequent week, according to Morgan Stanley. And that's our point. The rise in equity exposure means increased fragility. With further demand, there is further room for supply if equities were to fall and or volatility were to rise. So here's Peter Bookvar talking about just his bottom line around just what's going on out there. There is nothing easy about trying to figure out what's going on with the U.S. economy right now, but I'll try. Manufacturing is in a recession, as is the housing industry in terms of the pace of transactions and all the ancillary impacts that has on furniture, building supplies, etc. The U.S. consumer is mostly spending money on restaurants, bars, travel, and food, beauty, drugstores, and less so on everything else, although Ulta Beauty is getting creamed the past few days, I must say. Capital spending is going to follow the trend of earnings, and right now that is down. Bank lending is shrinking, and every single business, household, and real estate owner that has debt coming due each month this year and next will be faced with sharply higher refinancing costs. But inflation will be further moderating, and likely the Fed is done raising rates. The U.S. government is still spending like in drunken sailors, though the rate of increase should slow in the next year or two upon a debt deal. Inflation is further moderating, and it will as the economy continues to roll over, in our view. It's somewhat sticky, though, and the last few days, Fed Fund futures are starting to price in the likelihood of an actual rate hike or two over the next couple of meetings. Demand for commercial real estate loans is back to 2008 levels. Total return indices, this just speaks to that breadth. The top line here is just the top 5 stocks in the S&P 500, top 5 large cap stocks. And these lines are pretty much everybody else so far this year. And that's, again, a point I continue to make. EM central banks have been boosting gold reserves. Long-term chart of inflation and wages. We've been making this case since before coronavirus was something we were even aware of, that we're entering a new labor-friendly regime, which means better treatment of labor and higher inflation that goes with that. Here's the bar showing base pay increases, CPI inflation. Here's the 90s. Here's where we are right now. It's okay until it isn't. There we got an impressive improvement in GDP. I'm sure a lot of people were yelling about folks like us who still see recession coming. And this makes a point that, right before the last 3 recessions, real GDP growth in the previous 3 quarters averaged 2.7% right before the recessions began. So we want to be careful equating a decent GDP print this week with no recession risk going forward. High yield spreads are low relative to macro risk metrics. This just means the market's complacent. Macro risk metrics here identified by these folks in the yellow line, high yield spreads going down, and you see how typically there's a real correlation there. REITs spread between return on capital and weighted average cost is crashing, which signals declining profitability in the real estate investment trust space. Commercial real estate construction spending is expected to drop as credit tightens. Here's a correlation there, the orange line being spending, the gray line being lending conditions, and then loan demand in blue. That suggests that real estate spending, at least commercial spending, is going to be waning. Pending home sales, rolling over a little bit here, you can see this is your 2023 experience. Year over year, you can see we just took a little tick down, but we're still very solidly in negative territory. Freddie Mac, the U.S. 30-year mortgage rate is back up to 6.76%. Of course, that's constraining on the housing sector. Elevated mortgage rates keep a lid on home sales, as illustrated here. U.S. Treasury cash balance dipped below $50 billion. I talked about that, I think, yesterday. It was $47 billion. Treasury's just about out of money. The problem with this debt ceiling debate, and make no mistake, folks, the Treasury is going to need to be issuing a lot of debt going forward. And to the extent that they replenish the Treasury General account, that's bond selling, which pulls liquidity out of the economy. So there is going to be a liquidity drag. Typically, markets go up and the economy does well as this thing goes down. That's government spending going into the economy. And you know how good 2021 was for markets, right? You know how bad 2022 was. And so here we are in 2023. And so there is a negative correlation between the Treasury General account and the market. And again, boosting this up means pulling liquidity out of the economy. U.S. implied changes in the overnight rate. Here's where market expectations were in the orange line on May 17th. Here's where they are today. And you have the next 2 meetings discounting the potential for a rate hike, while significantly curbing expectations for rate cuts. And I just said that. Essentially, that just is another way of looking at this chart right here. So, folks, my basic overall point here is that the market is rallying here short term on likely more than anything else. Of course, we had NVIDIA and the whole AI story yesterday, although the majority of stocks actually went down yesterday. It was just the tech sector once again. And then today, it's just anticipating the inevitable, and that is, that they'll have an agreement on the debt ceiling. The rest of this just says that beyond that, we have I think on balance, a pretty precarious setup for markets going forward, and we're going to have to continue to therefore allocate accordingly. Folks, I'll leave it there. Thank you, as always, for watching and listening. Have a wonderful 3-day weekend. Talk to you next week. Bye-bye.